And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary Kay, who's out today. Today is Wednesday, April 30th, 2025, and we have a great show for you tonight. As always, I want to thank you very much for being here. All right, before we dive into the show and everything that's happening in the market and the economy, let's talk about some housekeeping notes. As you know, this is a show about you and your money and all the fun points in between. Just as a quick reminder, if you don't get the show in your city, you can go to GaryK.com or listen live or archive. We are live Monday through Friday, 6 to 7 p.m. Eastern. Also at GaryK.com, you can follow Gary on X, formerly known as Twitter, by just pressing the button. You can subscribe and get Gary's morning notes sent directly to your inbox for free every day, or every day during the week. Let's put it that way. Every market day, if that's a word, every business day, how about that? And you can email Gary, read the rest of his commentary, ask about his, see his posts, and also ask about his money management services, or whatever it is that you want to do. If you want his premium service, where he updates members in real time, several times a day, and does daily webcasts, again, business day daily webcast. Actually, it does it on the weekend too. You can go to convictionleaders.com. That's convictionleaders.com. All right, let's dive into today. We had a lot going on today. We have a lot of news. So in the morning before the open at 8:30 Eastern, the government comes out and says GDP came in and contracted in Q1. What does that mean? Well, GDP measures the growth of the economy, and it either expands, healthy economies expand, over time it expands, and there's periods where it contracts. 1/4 of contraction is not the end of the world. Imports soared in Q1 because, understandably so, people were worried about tariffs. So they're going to buy a lot of stuff. Now they have a lot of inventory, and they did that because if you buy stuff before the tariffs are enacted, you don't have to pay the tariffs. All right. So imports went, through the roof, huge, but also the economy contracted 0.3%. It wasn't a huge contraction. It wasn't 3% or 5%. It was 0.3%. All right. And that's the first read on GDP. That can change up or down, but that can change by the time we get the final read in the next few months, by the end of this quarter. Okay, great. So it comes in weaker than expected. The economy, or analysts were expecting minus 0.2%. It came in at minus 0.3. So, okay, great. So it's a little bit weaker than expected. So that means in the first quarter of 2025, the economy contracted. But if you look a little bit deeper, the inflation component of GDP, I won't get into the specifics, was much higher than expected. So inflation up, economic growth down. That's important to know. And that's another word for that is stagflation or stagflation. What does that mean? Inflation goes up while the economy is just stagnating. It's not really moving, not growing. Let's put it that way. So that's not a good place to be. Why? Because it impacts both monetary policy and fiscal policy. Two big words. Monetary policy is from the Fed, and fiscals from DC, Congress, the rest of DC. So, all right, White House, Congress, etc. But specifically, Congress and spending. Okay, great. If the Fed wants to cut rates, let's say the market has another leg down, but inflation's going up, their hands are really tied. Now, of course, they can always do whatever they want and cut rates and justify it based on whatever they want. But more, as generally speaking, it's a general statement, the Fed will cut rates. It's much easier to cut rates for the Fed if inflation is down. And it's much harder for them to cut if inflation is up. All right, so big picture, right away at 8:30, futures just implode. NASDAQ futures, tech stocks, S&P futures, Dow futures, just boom. Market opens an hour later at 9:30, and we gap down. All right, not a good open. But what ends up happening? Throughout the day, the market just basically rallies all the way up until the close. Now, you have a few things that are important to note. Trade deals are in play, in focus. White House shared some news. You want to say leaked it, shared it, whatever word you want. I'm not here to play politics. I'm here to show you markets and the impact on markets, that there's a possible trade deal pending. Could be with India, could be with another country, but they're very close to a trade deal. Okay, that helped the market rally after a week open. And you saw the market, lots of areas as well, just the bulls in general, step in and say, oh, you know what? It wasn't as bad as expected, because when you see the market close in the upper half of the range, especially a day like today where we had every chance in the world for it to fall, and yesterday we rallied into the 50-day, hit a wall, and then we gapped down this morning. What does that quote unquote mean? All right, most likely we're going to continue to fall. Doesn't mean we have to continue to fall. It just means odds are we're continue to fall. You got bad economic data. A lot of earnings came out today. I'll go through some of those. And you saw a lot of stocks gap down on earnings today. And instead, what happens? Market rallies. Well, it closes the upper half of the range. It didn't. Some of the indices closed higher, but for the most part, it was a mixed close. But it was a strong close nonetheless, because you closed in the upper half of the range. So when you put the pieces of the puzzle together, right, the Dow closed up on the day, up 141 points, or right around 40,669. The S&P closed up 8 points, but after being down a lot more, right? NASDAQ closed down a little bit, 0.09%, and the Russell was down just a hair, but upper half of the range nonetheless. And when you go under the surface, you can look at areas like the financials, XLF. They rallied today, closed a little bit higher, but they bounced off of the 200-day moving average. And they closed right near their 50-day moving average. This is the XLF. If you want to track it at home, you can see it. It had every chance in the world to fall, and instead of falling, it ended higher. And it closed 1 penny above its 50. But it was a good defensive day. Okay? The semiconductor stocks, SMH, same thing. Big defensive day. It's below its 50. It's below its 200-day. It's weaker than the financials. But it closed up on the day, and it had a big reversal, and it's moving sideways for the last 4 or 5 days here, almost building a little handle, consolidation, after a big move up from last week's low. And on the up days with the SMH, volume has been higher than the down days. We had 2 down days, yesterday and the day before, and guess what? Both of those days, you barely moved in the SMH, and volume was low. So volume patterns are coming in, quote unquote, better than expected. Maybe there's a change of trend here, or something is happening, right? The Qs fell today, had every chance in the world to fall, instead rallied right back, closed just beneath their 50-day moving average, an area to watch, right? We have a lot more earnings, by the way, after the close, which I'll get to in a few minutes. But even the S&P, the SPY, you're up now, what is it, 1, 2, 3, 4, 5, 6, 7 days in a row. That's a lot after a big sell-off, right? And again, the big view was that, okay, we'll get trade deals and come out of that stronger. That's the idea. But you're still below the 50 there. Watch the 50. The Dow, same thing. I think you're up there. What is it, 3 and 4? So 7 days there, 6, 7 days. I'm going to count fast here. 1, 2, 3, 4, 5, 6. Yeah, 7 days in the Dow. DIA is the ETF. And you're coming up to the 50-day. You haven't actually got above it, but you're coming up to it. It's a better tone, right? The fact that I don't want to say rallied on bearish news, but the fact that we didn't collapse on bearish news, to me, that's a bullish reaction, or that's bullish in and of itself. Why? Because it's not the news that matters. The news tells us what happens, in the first quarter, what happened, in the first quarter. The market's a forward-looking mechanism. So what if we have a positive outcome here, we get a bunch of trade deals, and then boom, you're off to the races. And tariffs go away, and you're off to the races. And you have a better situation than you did before the tariffs. Oh, okay, there's a positive outlook there. The market's starting to sniff that out, especially with all the news that's coming out of the White House saying, oh, getting close to trade deals, this, that, and the other thing, over the last 7 days. Not surprisingly, the market's rallied over the last several days. So again, it's not the reaction to the news that matters, folks. It's not the news that matters. It's the reaction to the news that matters the most. Even stocks that got clobbered overnight, Starbucks was down big and closed in the upper half of the range after reporting earnings. Right? Spotify had fallen, SPOT is a ticker there. Starbucks is SBUX. Spotify fell yesterday, and then it rallied, closed in the upper half of the range yesterday, and then jumped today. And now it's above where it was on Monday before they reported earnings. That's a good recovery. So again, we'll take our time. We've got a lot more to cover. It's one day today. It's a good day. Good close. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. I'm Adam Sarhan in for Gary K, who's out today. In case you missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen at your convenience anytime you want, all for free on any device, 24/7. So we spoke about the news. It was bearish news this morning. Market closed higher, if not upper half of the range, mixed to higher. It was a very strong positive reversal, and that's what matters. So the stagflation fears may be overdone. That's what the market's saying. And again, I like to say in my book, it's called Psychological Analysis. You can get it on Amazon or Barnes & Noble. And thank you, everybody, for leaving good reviews and reaching out and letting me know what they like about it. I say there's an infinite number of ways to make money in the market. The idea is to find one that works for you. I also say the market's speaking and then ask, are you listening? And the way the market speaks, it's nonverbal communication, just like most humans. Turns out most of our, I don't know if this is an absolute fact or not, so take it with whatever psychological grain of thought, salt you want. Double check this. I'm not stating this with an absolute certainty, but I read it somewhere that most human communication is nonverbal. So the market's nonverbal. It's not going to come out and say, hey, I'm going higher. Hey, I'm going lower. It gives you clues, price, volume. All the news is baked into the price. What shows up in your statement? Not the news, not volume, not earnings, not schmurnings, price. And that's why for me, price is primary, everything else is secondary. So when you see a stock like Spotify gap down on numbers yesterday and then rally today and repair all the damage and then some, that's a good sign. After the close today, we have several stocks that have reported earnings. I'm going to go through a few. I believe, Qualcomm came out with numbers. QCOM is a ticker there. It's down about 4.5% right after the close. We also have Meta, META, report earnings. They're up about 4%, 4.4%. That could change. That's a good reaction. Qualcomm, not a good reaction. Other stocks going to be reporting. I'll share that later as the day goes. We're in the midst, or the middle, like Gary says, the midst. We're in the middle of one of the busiest weeks in all of earnings season. Microsoft came out, and they're up about 5.5%. Now, this is still fluid. It could change. They still have their earnings calls, and they're going to see what their CEO say, and the team, and the analysts, and all that kind of stuff. But for now, so far, the reaction to the earnings so far have been positive. Now, another important point is that it's end of month. And we tend to see a rally into end of month, and that could be what's happening now. I'm not taking anything off the table, especially in this market. Now, could we have a bad headline overnight and wake up tomorrow down a lot? Yeah, of course. So I'm not in a situation where it's like, oh, okay, all bullish, just go gangbusters and all clear and buy. Yeah, not so much. I'm just saying that there's more bullish pieces. Here, let's use something Gary likes to say. There's more bullish cards coming out of the deck, right? There's more bullish pieces stacking up. That's it. On a weekly basis, and actually on a monthly basis, today's end of month, so I can talk about end of month also. This was a strong recovery this month. We had every chance in the world to fall, and instead, we ended mixed to higher. The NASDAQ 100 ended higher this month. I'll give you a month-end review now over the next few minutes. In the middle of the beginning of the month, really in April, early April, we pulled back down to 402. The high in 2021 was 408. So it was resistance. It now became support. If you haven't done so, I recommend go look at a monthly chart of the NASDAQ 100, the QQQ, and you can see it, almost perfect line in the sand. The old chart highs, that 408 level, became resistance. And the day that it hit that 408, it undercut it, went to 402, it was the low. It was April 7th, and it closed that day at 423. Didn't even close below 408. That is impressive. The next day it fell a little bit, closed at 409, and then just rallied since. The day after that was at 49, April 9th. He had that huge day. It was the biggest update in the NASDAQ's history. When Trump came out and said, hey, guess what? We're going to give the 90-day extension and lower the tariffs and this, that, and the other thing. And it's a good time to buy and blah, 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 blah. Huge rally. That was a day 3 follow-through day, or a confirmation of a new rally attempt. And then you sold off hard for the next maybe week and a half or so. And then the middle of last week on the 21st, market came out and said, oh, got some more headlines out of the White House, positive headlines on trade. And guess what? Virtually straight up since then. That's the NASDAQ 100. The NASDAQ Composite, similar situation. 16,212 was the old chart high from 2021, so 21, November of 21. The low this time around, or this month's low, was 14,784. So it undercut a little bit, but on a closing basis, we're up at 17,446. Just extremely powerful. And why am I taking time to talk about the monthly outlook? It's important to step back and look at the forest, not just the trees or the leaves on the trees. A lot of people look at the intraday charts. I call that the leaves on the trees, the minute chart, the 5-minute chart. The daily chart is the actual trees, in my opinion, and the weekly, monthly, and quarterly and annual charts are the actual forest. You know, this is a big reversal month, the month of April. Big defensive month. Let's look at the S&P 500. Look at SPY since we can trade that. The S&P 500's old chart high was 479 in 2021. The low this time around was 481. I'll say it again. 479 was the high in 2021. 479. The low was 481. Didn't even undercut the low. And closed in the upper half of the range. Closed down 4 points for the month, but still upper half of the range, especially after bouncing off of what was resistance is now support. Wow. That 481 level, wow, that is impressive. You go back 4 weeks ago at the beginning of April, the end of March, and ask me, hey, would that happen? Probably, it's possible, but I wouldn't have given it a high probability event. Now, if the facts change, like the facts did change, right? The White House, Trump did the 90-day extension that day, and then the market took off, and the facts change. Okay, there's progress on trade deals, so on and so forth. All right, we've got to change as well. I'm not the kind of guy that's going to sit here and say, oh, I was bearish on this or I was bullish on that. No. When the Lord Keynes, a famous economist, had a great line, he goes, when the facts change, I change. What do you do, sir? It's a big way of philosophy and just being open-minded, right? And evolving and changing and staying in harmony with the market. It's a play on the word harmony. It's not a real word. I made it up. It's harmony. What's the idea there? Stay in sync with the market. It's very tempting and very easy to try to quote unquote fight the market. Trust me, I've done it for years. It's a losing proposition, guaranteed every time. Your ego gets in place or into play. I'm right. I got to prove the market wrong. Blah, 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 blah. That's why I wrote the book, The Psychological Analysis. I'm not a psychiatrist. I'm not a psychologist. I'm a practical guy. And I know humans make emotional decisions. I want to make better decisions. All right, up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, pause, listen to any part of the show anytime you want on any device, all for free on GaryK.com. All right, so we left off talking about the importance of making rational, not emotional decisions, but how people make decisions, right? All right, be flexible in the approach. Stay in harmony with the market. Listen to the market. I always like to say the market's speaking and ask, are you listening? Well, how do you listen if the market's not literally talking? The way you listen is by focusing on price, on how the market behaves. Imagine I walk into a room and I start acting very erratic and I jump up and down and all this weirdness comes out. You're not going to want to be around me. Okay, great. Now imagine I walk into a room, I'm calm, cool, collected, smile, I have good energy. Much higher likelihood people are going to be attracted to that type of a character, opposed to one that yells and screams and jumps up and down and curses and goes nuts and this, that, and it causes chaos and breaks things and throws a chair around the room and just goes bonkers. I'm not saying emotions are bad. I'm just saying think of the behavior. And a lot can be learned by how the market behaves. And what's the one of the best tells is the reaction. I spoke earlier about the importance of focusing on the reaction to the news. It's not the news that matters, it's the reaction to the news, right? All right. Same thing with earnings. Well, this company lowered guidance or didn't report guidance. Or Adam, what if we're in a recession? What if we're in a correction? Well, we are in a correction, but what if we're in a bear market? All right. You adjust. That's the power of this business. Is there's quote unquote no rules requiring us to be anything. I don't have to buy a stock. I don't have to be fully invested. I don't have to be anything. Some big funds, hedge funds, mutual funds, so on and so forth, institutional investors, they have mandates and charters. They have to be fully invested or 95% invested all the time. I know I have many of them. I've worked with them. I have them as clients. I see them. Just how the world works. These guys are just a different almost energy or vibration, different universe. They're different, pond that they're swimming in. Think you're going fishing. It's a different pond. Their hands are tied. That portfolio manager one time told me, Adam, I want to get out of the way. I can't. So he takes a defensive position. There's a way just to do that with defensive ETFs and so on and so forth. But he has to always be invested. Thankfully, most investors don't have that requirement. They have the flexibility. So when you look at the market and you look, oh, okay, let's stay in harmony. The financials are back barely above the 50, but back above the 50. The XLF, right? We spoke about that earlier. And we've got bullish patterns forming in the market, which mainly we've seen a lot of double bottom patterns. Double bottom looks like a W. Not a perfect W, but somewhat of a W. And you can see that in Spotify, actually, if you wanted to. You go SPOT, you got a double bottom forming there. One bottom, the left side of the W is 483.65, and the right side is 475.01. And now you're coming up to the middle of the W, which is the 621.20. Netflix, let me go check, did that a few weeks ago. Yep, had a double bottom, NFLX. You can take a look at this on a daily chart when you have a chance. 854.50 was the left side of the W. The right side was 821.10. That low was a low in April, early April, right? Came up to the right side, basically has gone straight up since. Had 3 down days since in the entire month of April. Wow. Broke out of the middle of the W, 998.70. Broke out above it on, I think the day they reported. No, a few days after they reported. On the 21st. Okay. Closed in the lower half of the range that day. And it's been up every single day since. Wow. One of the strongest stocks in the market right now. Growth stocks, right? Strong earnings. Their quarterly earnings are growing double digits. Their annual earnings are very impressive. In 2020, the company made $6.08. In 21, earnings soared to $11. In 22, it went to $9. Okay, not growth, but that's okay because things slowed down after COVID and all that craziness. 23, earnings jumped to $12, higher than 21 at 11. And then 24, earnings came in at $19.83. And 25, earnings are expected to grow by another 30% to $25.51. 26, earnings are expected to grow to $30.93. Wow. Wow. But look at the chart. Double bottom pattern broke out, took off. If the market's going to resolve itself and go higher, and I'm not saying that's what's going to happen. Nobody knows what's going to happen with absolute certainty. But you put the pieces together. And if we roll over and fall, bye-bye. You get out of the way. And we don't even have an all clear. I had a guy call me today. He's like, hey, can I buy the 3 times long, market ETF, blah, blah, blah. I said, we're below the 50. We're below the 200 day. Now, could that trade work out? Sure, it could. Again, for a trade, not for a long-term investment, but for a trade. Yeah, do whatever you want. With risk. That's the key. Respect risk. But it's not all clear. We're below the 50 day. We're below the 200 day. If this is indeed the bottom was in April, and we're going to continue to rally from here, and we'll get trade deals, and there is no recession, or it's a very shallow recession, and then we have a very strong second half of the year, and earnings are expected to grow, and everything's hunky-dory, great, the market's going to tell us. The action's going to improve. More areas in the market are going to perform better. The semiconductor stocks are an important area that have been lagging recently. We'll see them wake up and get their mojo back. We'll see the biotech stocks, health stocks have been under pressure recently. The XLV is the health ETF. Biotech is XBI. See them come back to life, right? Possibly. Financials are already starting to improve a lot from where they were just 4 weeks ago. Again, end of month, I like to zoom out and look at the forest. All right. Again, individual stocks. Do we see more stocks like Netflix break out, hit new highs? Or do we see stocks like United Health, UNH, gap down after reporting earnings and really to keep falling and just get crushed? Time will tell. It's one day at a time. And Gary does a phenomenal job staying ahead of this for everybody and does it daily. The NASDAQ 100 as of today's close is down about 12% from its 52-week high. And now it's on track for its third up week in the last 4. The S&P 5, again, we have to see where we close on Friday. We have a lot of earnings coming out tomorrow. You got Amazon, you got Apple, you've got, hundreds and hundreds of stocks going to be reporting, and many big ones as well. And then you have the jobs report on Friday. So this is not a slam dunk. All it is like, okay, it's a good day today, right? But for stepping back, for just seeing where we are at the end of the month, for just a forest kind of point of view, this is a correction now. We barely went below the 20% level, and we got right back above it. So, okay, the market's in a correction. The S&P 500 is down 9.6% from its 52-week high. That's a good sign, right? The Dow is down about 10% from its 52-week high, correction territory. The pullback is 0 to 9.9%, correction is 10 to 19.9%, and then a bear market is over 20. Typically, that's how they define bear markets, corrections, and pullbacks. Again, pullback is 0 to 10, 10 to 20 is correction, and then over 20 is a bear market. But that's a good sign. But as we go down the market cap totem pole, the mid caps are down 16.6% from a 52-week high. But they're up 4 weeks in a row, rallying right into their 50-day moving average. We'll see what happens there. The Russell 2000, IWM, the mid caps, by the way, ETF is MDY. The Russell 2000 is IWM, and it's recovered a lot, up 4 weeks in a row also. That's 20.5% below its 52-week high. It was down almost 30, or maybe right near 30. I don't know the exact number, but mid-20s. And now you're down 20.5%, clawing its way out of that deep hole it was in. You're still down, still below the 50, still a lot of room to go, but it's a day. It's getting better. And it's not just one day. The last 2-3 weeks, we're seeing, the last week or so, a change, like Gary says, in complexion. So we'll see. And if we roll over, bye-bye. Defense, defense, defense. We're still in a downtrend. We're still in a correction. This can easily roll over, folks. All I'm just saying, big picture, zooming out, it was a strong month. Up next, we've got a lot more to cover. I'm Adam Sarhan. This is the one and only Investor's Edge. And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen on any device for free anytime you want. All right, so spoke about GDP in the morning, spoke about a big positive reversal for the day. Also, last few weeks, the complexion is improving big time, or bigly, any word you want to use, right? That's a good sign for now. More cards have to come out of the deck. We have Amazon, Apple, lots of other stocks are reporting earnings. And we're going to pay attention to the big ones, and we're going to pay attention to how the market reacts to the news. We had bearish news this morning. GDP contracted, fears of a recession kicked in, stagflation kicked in, inflation's higher in that GDP report. Market didn't care. Well, first off, it opened lower, so it did care at that point. But really, by the end of the day, bulls emerged somewhat victorious here, had a strong day because it closed in the upper half of the range. For the month, at the end of the month, guess what? Same thing happened. Opened lower, closed higher. It depends on the index you're looking at, but closed mixed to higher. When people ask me, oh, how do you listen to the market, Adam? How do you make sense of what's happening? Here you go. A subtle sign, there's lots of ways, but here's one important way, is just look at the price. Price going up, that's bueno. That's good. Price going down, no bueno, right? For the bulls. That's good for the bulls, and that's not good for the bulls. All right, so when you open lower and you close higher or in the upper half of the range, that's a subtle but important sign that the bulls have a little bit of an edge for that period of time. Daily charts, weekly charts, monthly charts, intraday charts, it doesn't matter on the time frame. The longer the time frame, the more powerful, or the more oomph it has, for lack of a better word. The more importance it has, the more weighting it has on the longer time frames. But a weak open followed by a strong close or upper half of the range close, think of a game of tug of war. It shows you that the bulls have a slight advantage. And the opposite is also true. If you have a strong open and a weak close, that shows you the bears have somewhat of an edge. Now, it doesn't have to be, but somewhat of an edge. Okay, great. When you have a situation on a monthly basis, you did that, right? You did it today on a daily basis, and then you put another layer on top of that. When you get bearish news and you don't sell off and you're in a correction, guess what? That in and of itself is very impressive. And that's what I mean by a strong month, strong day. It's okay. The fact that we close in the upper half of the range, that's a strong sign. Doesn't mean we have to go higher from here. Doesn't mean we can't open tomorrow and gap down a gazillion points because I enter any headline you want. No. All I'm saying is that it's another bullish card that came out of the deck. The fact that the reaction to the news is what really matters. And it was a good reaction today where you sold off hard and closed in the upper half of the range, depending on the index you look at or the market or the sector you look at or whatever it is. Okay, great. That's a good subtle sign of strength. Because I'm getting asked all the time, Adam, how do you know if this stock's strong or not strong? Well, just look at the price. Is it going lower left to upper right? Again, respect the trend. Right now, this is a correction. Most corrections end. Most corrections, even if you dip into down 20% or down 25% for a short amount of time, like what happened this time, don't lead to new huge bear markets. And we've already seen the White House pull back a lot from their stance on tariffs. Not a mistake, because the market went down so much. Okay, well, if they reverse their stance again or change their mind again or get trade deals or they gave a 90-day extension. What if they give another 90-day extension? You follow? That's 6 months, 2 90 days in a row, or 3 months and 3 months. So when the facts changed, the market fell because tariffs and the Liberation Day and all that kind of stuff, and then all of a sudden that was dialed back. Markets started going up again. So we'll see. But for now, what I want to say is that when you look at markets, you look at your stock, ask yourself, how am I aligned? Am I aligned or not? How am I performing is what I was going to say, but how am I aligned? Or do I find myself fighting and struggling? That's a good sign for me to see whether or not I'm on tilt or not on tilt. And that's a term that they use in other industries where it's like, oh, you're a little off. You're hot or not. Think of basketball. They have the playoffs now. Okay, great. Someone has a hot hand. They're just firing on all cylinders. Okay, great. They're not hot. It happens to the best of us. Any performance-based business, which this is a performance-based business, you have the potential to make unlimited money on the upside, virtually unlimited money, no limit. And you have the potential to lose all your money and then some, which happens. You see people do both, right? In between. But you get paid to perform. Athletes, performance-based business. Michael Jordan can literally show me what he does to shoot a basketball. I'll have a complete different shot. His height's different, his bones are different, his eyes are different, his sense of his experience is different, so on and so forth. Athletes perform. You can look at actors, same thing. George Clooney could sit here and tell me how to act and show me exactly what he does. I won't be able to do it the same way he does. So in a performance-based business, a lot of the performance depends on how the person, the user, upgrade the user, how the user performs. So my focus is when I find myself on tilt or off or cold streaks, and they happen to everybody, just back off. I don't fight it. Let some time pass and then come back. And when you come back fresh. And when you come back fresh, guess what? You get to reset. And the time off and all that kind of stuff, it varies depending on everybody. But being able to handle those cold periods and not fighting the market is muy importante, super important. Why? Because you don't want to dig a hole. If you're digging a hole, stop digging. Buffett has 2 rules of investing. 1, don't lose money. And rule number 2, don't forget rule number 1. We're in this business to make money. If you have a huge drawdown or a huge, you start digging a hole, which has happened to the best of us. I've bankrupted my accounts, 4, 5, 6, 7 times 25 years ago or so. More than 25 years now, or thereabouts. Multiple times. And I've seen countless people do it. And I've seen people recover. And I've seen a lot of that. Most people don't. Because the PTSD, the psychological trauma that comes from that, losing your money, is extremely painful and difficult to deal with. You can avoid that by taking small losses and not letting those losses get too big. And when things aren't working, dial back a little bit. Know yourself. Know thyself. Right? And find out what works well for you. And try to stay in harmony with the market. I hope this is helpful. I believe that's all the time we have for today. As always, want to thank you very much for being here. I believe Gary will be back tomorrow. It's another day. So tomorrow's a new month. Thank you, everybody, and I'll speak to you again soon.